This is exactly what you were pinpointing and saying to us last week was the case. Watch Morgan Stanley, watch Goldman Sachs, and of course Deutsche Bank on the qualitative side.
Yeah, I mean, almost everybody, we had ever talked to all the analysts were expecting Deutsche to fail because they're already on probation lists by the Fed, by the FDIC, so it'd be shocking if they passed. On the Morgan Stanley Goldman side, in the DFAST results we got last week, their numbers on leverage came so close to the minimums that the math didn't work. They couldn't really increase their payouts and pass. So. What's really interesting is they're still getting a little bit more than what people were expecting because a lot of analysts looked at that numbers and said, oh, not only they cannot increase, but they have to decrease from last year. And the condition that they're passing with actually allows them to stay at the levels of last 2 years. And that's a little better than what people were expecting.
The thing that I think is important to think about in terms of the way the Fed is obviously looking at it also is banking versus investment banking.
Yeah.
Deposit assets versus securities business, trading, et cetera. And so especially given the fact that, there's questions about what's going to happen in the economy as the Fed hikes. We've got an ugly yield curve. And so I think the Fed is thinking about that future. And that's part of what we forget is it's not really the current condition, it's the future condition.
And I think it's worth noting, looking at the after-hours reaction here, pretty muted, even for these ones that didn't have the best results. So obviously markets pricing a lot in, particularly after last week's. On the qualitative side of this, it's easy enough to sort of look at the assets and sort of make an assessment of how far they'd fall. On the qualitative side, what is that approach to going into a company and saying, we don't like the way this is?
Well, I mean, look, we have this many years past the crisis, a number of institutions that are still having significant operational risk problems, management problems, and they keep popping up as surprises. Now, obviously, we've got America's favorite bank to hate, Wells Fargo, deservedly so, continuing to have those type of problems. Deutsche Bank just settled with New York State for $205 million. So those are the clear poster children for the reasons for these qualitative tests. I think what we're going to see, though, is going forward, the administration, I think everyone expects deregulatory environment. I think this administration is going to keep the pressure on the largest banks in a very real way. Remember, it's a fan of the community banks, not of the SIFI banks. And the SIFI banks are really, for the most part, East Coast, West Coast, so they're not in his base anyway. And I think that really is going to matter. So we've seen the GSIB, the big banks ask for relief on the GSIB leverage ratio. I think that's going to be hard. So if you're looking for sort of some relief for the big banks, I think you're going to have an increasingly difficult curve. I think you've got a recession that's going to be coming on next year. We're seeing slowing in the mortgage market. We're seeing increasing problem loans in subprime auto and cards. And then I think one of the things that we have to think about, and I know that you've been thinking about it, is what is the real condition? Because if you look at the debt portfolio of the banks, it looks like it's been scaled back pretty dramatically, but we're not really sure what ultimately comes back onto the balance sheet as risk.
Yalman, come back on this.
Yeah, I mean, what we look at 10 years later, it's been 10 years since the crisis, initially the reaction from our regulators, the government, the rules were really stepped up. Capital levels went up so much. And looking at the stress test, for many years, most of the profits, they just had to hold on to them. The last few years, they've been able to return more and more. And we're getting to basically about 100% levels. In other words, you can distribute your profits now because you have enough capital. But we're still not there, really. 95% is the average for the banks that are passing, which is 34 of them. That's still not 100. So they're still keeping a little more. And, as we saw with Morgan Stanley, Goldman Sachs, even though the Fed explains that it's because of the one tax reform that passed at the end of last year, which hit every bank with one-time charges that brought down their capital levels. They had to have huge billions of dollars in one-time charges, which are really one-time. And going forward, the tax reform helps them. They can hold more of their money profits instead of giving it to the government. But still, are asked to maintain levels, which means capital is still strong. It's much better. It was about 3% leverage ratio when you calculate all kinds of other things. I tried to make apples to apples with today's rules and last before crisis. It was 3% of assets were capital. Now it's about 7%. It's more than twice.
And it's worth noting that Fed Vice Chairman Randy Quarles made exactly that point, even with the one-time challenges posed by changes to the tax law. He says the CCAR results demonstrate that the largest banks have strong capital levels. So fundamentally, even
they're very strong, and I don't think there's any question about that. I think one of the things that we need to question, actually, that we haven't is, okay, so we shored up the banking system, and I think we largely have, obviously, other than some operational risk issues, which are significant in some cases. The question is, where did the risk go?
Yeah.
Okay, and to me, as we head into a new economic slowdown, recession, third, fourth quarter next year, where are those risks going to pop up? And I don't think that they're going to be in a major way in the banks. The banks have gotten smart enough that, yes, there's some repo transactions that are hiding their exposures at the end of the quarter. But for the most part, we're seeing banks, because of the grab for yield by investors, originating loans now, not even to hold it all and not to securitize, but to sell off as whole loans. That's going to end up hitting some large asset managers in the future.